Today, we're showing you how to make a £20,000 per year basic passive income in dividends from shares, and how much money you need to have invested to achieve this. The destination is financial freedom. You don't need millions sat in the bank to be financially free, but what you do need is a regular recurring income stream which keeps you topped up for life.
Dividends are the ideal income stream because they are passive. There's almost nothing that you need to do and the money keeps coming in.
Financial freedom is available to anybody through investing in shares. But first, we need to look at how you can build up that sweet monthly dividend income. Let's check it out.
Welcome to Unshackled.com, the investment and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe.
We want to give a special shout out to Stake, who are sponsoring this video. We'll get to how they can help you later in the video.
How big does the portfolio need to be? To get £20,000 a year in passive dividend income, you ideally need a £500,000 portfolio. This is because £20,000 is 4% of £500,000.
The 4% rule. The stock market typically returns 8% on average. Pretty sweet. And that growth is essential for powering us towards our target pot size, which will then pay us £20,000 dividends a year. Once we've built up a pot and are ready to draw down on it, we don't want our pot size to decrease by doing so, because then our future dividends would get lower and lower each year.
If the total return of your portfolio is 8%, we can't just withdraw 8% per year without damaging the pot, because we need to factor in the effect of inflation. Inflation hovers around the 3% mark on average in the UK. We want to keep 3% from our return invested in the pot each year, so that the real value of our pot stays the same.
This leaves us with a 5% difference to withdraw by our maths, but most investment gurus refer to the 4% rule, which is a more prudent limit to what is safe to withdraw from your pot each year. You can weight your portfolio in favour of stocks which pay higher dividends of around 4% or more, sacrificing some growth to in effect automate your cash flow.
Why £20,000? 20 grand is a good amount to aim for because it meets two opposing problems in the middle. First, £20,000 is about enough to live on for most people, and it means you can quit your job and free up your time so that you can make more money doing something that you enjoy if you choose to.
Second, an investment pot size of £500,000 is just about reachable for most people if you really tried hard and focused relentlessly on the goal. There are life choices that you can make to help you reach it, like not trying to acquire an expensive house. And whether it takes you a few years or a couple of decades, it's not a number that is forever out of your reach.
Exactly what to invest in. You have a few options when building a dividend portfolio. You could go down the fund route, investing in high dividend global ETFs. The Vanguard FTSE All World High Dividend Yield ETF is one of our favourites. As well as expected growth, it has a yield of 4%, which does exactly what we need it to. We want our pot to pay us out at least 4% a year to achieve our £20,000. This fund also pays quarterly, so is ideal for regular cash flow.
Another route is to take more control and build your own high dividend stocks portfolio where you carefully select the best dividend stocks. Here's 5 amazing dividend paying stocks that we think will be ideal for this objective.
Number 1. Exxon Mobil. These guys are America's #1 oil company and pay a whopping dividend of 8.16%. They had an unbroken record of raising dividends each year for 37 years until 2020 hit, when they decided to freeze it. But at over 8%, we're not complaining.
Number 2, AT&T. A massive American telecommunications group, these guys pay a dividend yield of 6.99%. It's just amazing.
Number 3, Universal Corp. One of the world's leading tobacco merchants, this company joins AT&T in spots 1 and 2 in the highly respected SPDR Global Dividend Aristocrats Index. To get those top spots, they needed to pay consistent high dividends for 10 years plus. Universal Corp has a dividend of 7.49%.
Number 4, Johnson & Johnson. It's important to realise that a high yield isn't everything. Consistency counts a lot too, as a strong track record bodes well for the future.
One of the world's biggest healthcare companies, Johnson & Johnson has an incredible track record of increasing its dividend payouts, and its yield of 2.78% isn't that far off our 4% target, especially when combined with other high-paying dividend stocks in our portfolio.
Number 5, Coca-Cola. Coke pays 3.62% yield. They are a globally dominating brand with excellent fundamentals that has survived the test of time. And look at their track record too of consistently increasing payouts. Coke are not going anywhere.
You can buy these 5 stocks on the Stake app, which specializes in US shares. It has 3,700 US stocks and ETFs available, including all the US stock market giants.
What's more, Stake offers unlimited commission-free fractional trading with trades executed in real time, and it is of course FCA regulated and has straightforward, no-nonsense pricing. Stake will give you a free US stock worth up to $100 when you sign up via our link. We'll put the link to the offers page in the description below, so be sure to check that out.
Dividend stocks versus growth. You might be tempted in the early years to focus entirely on growth stocks while you build your pot, and then switch to high dividend paying stocks in the future once your pot is complete.
This is not the approach that we would take. If you invest purely for growth, such as into high risk stocks like technology small caps, you are far more dependent on market forces and speculation. Known as growth stocks, they tend to pay no dividend, preferring to plough cash back into the business for faster growth. Investors usually love this, as the share price in theory should rise faster.
You might get great growth, but that money is not yours until you sell the asset. Whereas if there are dividends paid as well, some cash goes into lining your pockets during the years you are invested. A bird in the hand is worth two in the bush.
Dividends are a sure thing. Companies can cut dividends, that is true, but companies that pay out dividends on a regular basis have it built into their core culture that they must continue to pay out to investors, or else risk damaging their reputations.
Those companies who cut their dividends during the coronavirus pandemic will no doubt reinstate them at the first opportunity. Shareholders would be baying for their blood if they didn't. Building a globally diversified portfolio that invests both in growth stocks and high dividend paying stocks is a better strategy for assured growth than banking on stock price growth alone.
How to get your portfolio to 500 grand? To climb that mountain, you're going to need the twin pickaxes of time and compounding. £1,000 invested now could be worth £10,000 in 30 years' time, so it's important to start early. Reinvest all your dividends into your portfolio while you build to get to the end goal faster.
Here's 3 routes you could take. Number 1, invest £500 a month. If you invest £500 a month, it would take 33 years for your pot to be worth £500,000 in today's money, adjusted for inflation, at an 8% return. 33 years is a long time, which is why you might want to focus on increasing the amount that you can save each month as a priority.
Number 2, invest £1,000 a month. Keeping the example going, if you could get your monthly investments up to £1,000 a month, what we half-jokingly call one freedom coin, now we're getting into more sensible territory. You could get up to £500,000 in 23 years. A wily plumber or career ladder climber in their 20s could be financially free in their 40s. But how can we get there quicker?
Number 3, increase your returns with stocks. To get there quicker, you need to crank up your return. So you might want to look at moving away from dependable funds and towards building your own stocks portfolio, aiming to beat a single-digit return.
You might use some of the ones that we mentioned earlier. As we're growing our pot, we'd be looking for a mixture of dividend yield and growth. Picking the best stocks won't be easy, but it's the only way to get a better than average return in the stock market.
Get your savings per month up to £1,000 a month ASAP. This is key and should be your goal for the early years, to crank up your savings per month figure to £1,000 or more. Options include plotting a new and more lucrative career course, starting a side hustle home business, downsizing some expenses, moving city to somewhere where life is cheap, or any other way you can think to supplement your income.
Learn by doing and compound. In the meantime, it's still a good idea to start investing as soon as possible. Anything you invest in the early years will likely compound by many magnitudes over your time in the markets, making £100 invested today count in the thousands in the future. And you're learning the ropes, so by the time that you have more to invest, you'll know where to put it, and crucially, you won't be afraid.
Question of the day: when will you be retiring on your dividends? Let us know in the comments below.
Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.